The hard part is for the people at the bottom, it's not good. It's really not good. For the people at the top, they don't really care. They're good. The people in the upper half, they'll be fine. It is really hard for the people at the bottom. And look, we've all seen pictures of the Great Depression, the bread lines and the Dust Bowl. And for the people at the bottom, it's super hard. And if you look at the pictures of London in the 1860s, right? The people at the bottom, the Tiny Tims and the Christmas Carol story and all that, it's hard. But the country moves forward and moves on.
A string of recent Treasury bond auctions saw a major slump in investor demand, and that could be a harbinger of a trend that sends yields higher, strategists said. On Thursday, the U.S. sold $20 billion of 30-year bonds, but dealers had to pick up 18% of the sales, greater than the typical 11% share, as more buyers balked. That followed similarly weak auctions this past week for 3-year and 10-year treasuries. Meanwhile, a potential U.S. debt crisis, a fear that has helped drive the sharp Treasury sell-off since August, is not an inevitable scenario, Yusko said, though it is a real concern. In his view, yields are soaring as activist traders known as bond vigilantes are trying to push interest rates to levels that will force the U.S. government to tackle its runaway deficits and debt. If left unaddressed, the fiscal situation will reach a breaking point that could send the U.S. into some form of default. Let us now hear what Mark Yusko has to say about this. As you watch, don't forget to like, subscribe, and drop your comments.
I think inflation has peaked. I think we're heading back down with one caveat. If this skirmish, and again, I don't mean to your point earlier, prayers and hope for all the people impacted by this. I can't imagine what's going on and having to move and flee from bombs and I can't imagine. I've never experienced that. So I'm not trying to minimize, but right now it's a localized, well, it's fine. We'll call it a war. It's not a skirmish. It's a war. It's a full-fledged war, but it's in a small area. But if it expands to the region, oil prices go up a lot, like a lot. And if that happens, inflation short-term goes up and economic growth comes crashing down. And in that scenario, I think your point on Janet loses control and she gets stuck trying to thread that needle and people call bullshit. And we're at 6% on the long end in 5 heartbeats. So, there's a guy literally, I think right after we recorded the show said, I'm all in long bonds, 84.04 on the TLT. Damn, that's brave. And he's been right? It's up 3.5%. That was a good trade. Most people believe, and I think that's why wars are started, that war's good for the economy. It's good for stocks and it's good for GDP growth. Well, it definitely is good for defense companies. It's definitely good for auxiliary businesses that support the war effort. And historically, it has been good for GDP growth. And historically, it actually has been good for the stock market. I fear in this case, where an expanded Middle East conflict would have such a deleterious effect on oil in a time where oil's still really important and where, we don't have the strategic petroleum reserve and all kinds of other challenges. I just think it would catch people off sides. And I think we'd end up with the 2022 kind of redo. I could see a down 20% in equities easy. You'd lose at least that in your long bonds, maybe actually you'd probably lose more like 30%. It'd be ugly. And the other problem is liquidity dries up, right? Because you got this commitment, to shrink the balance sheet. Well, I think they'd have to throw that out the window. I do. Because at the end of the day, there are no buyers. So the buyer last resort has to be the central bank. And that, my friend, is what Paul Tudor Jones said. That'd be good for gold and good for Bitcoin. And I love how I like Bitcoin. It just doesn't matter. No
Right.
one borrows at Fed funds. Right? The average car loan, which is a crazy stat, It's like 17%. It's like, no, there's all these zero loans. I'm like, yeah, rich people get zero, but the average person is not getting zero rates. I mean, they're paying double. I heard car loans can go all the way up to 29%. Holy shit, that's like a credit. We have currency devaluation, right? That's what we have. We created way too much currency, and the Fed's trying to fix that. I actually give credit to Jerome Powell, who might be the only person who isn't in the bad actor group. Right?
I feel like he's deserved credit.
He literally is independent. I think he means well. I think he's not part of the BlackRock, Goldman, Treasury Secretary, like billions cast. I think and you saw it. He's trying to run off the balance sheet. He's trying to. He got M2 negative for the first time in 100 years because he realizes Kelton was wrong. Right? You cannot create unlimited money with no impact. That was never a good idea. That was Krugman-esque. That was not smart. And I applaud them. But it did create currency devaluation. And it meant the price of everything that people need, housing, shelter, food, transportation, went up a lot. Not because those things got better, because the money got worse. And to your point, what is the only response when things get really ugly? Print more money, right? That's the only way out. And I mean, and it's just the law of large numbers, right? We created $500 billion in national debt in the last, 3 months? $500 billion? I mean, and someone put up, it like took, I don't know what it was, 100 years to get the first $500 billion. And then we did $500 billion in 3 months. I mean, the only thing that makes me feel good about that is the opportunity in data, where I think we talked about this last week, right? That from the beginning of time to 2003, 5 exabytes of data were created.
For those new to the financial lingual, treasuries and bonds are both types of debt securities that entities issue to raise capital. Here's a brief overview. Treasuries are issued by the government, specifically the U.S. Department of the Treasury for the U.S. They are considered one of the safest investments because they're backed by the full faith and credit of the U.S. government. Common types include treasury bills, short-term, treasury notes, medium-term, and treasury bonds, long-term. Bonds are general terms for a debt security where the issuer borrows money from the bondholder and promises to pay back the principal amount at a specified maturity date, along with periodic interest payments. They can be issued by various entities including governments, municipalities, and corporations. The safety and interest rate of bonds can vary greatly depending on the issuer's creditworthiness. Both are used by issuers to finance projects or operations and by investors to earn interest and potentially benefit from price appreciation. Let's get back into the video as Mark Yusko shares more insight on the projections.
Long-term is going to be the issue that there's not enough buyers, and there's this really interesting problem. So we've alienated our formerly largest buyers of treasuries, the Russians, the Chinese, Japanese, even the Germans and the French, and pretty much pissed off everybody, Saudis. And so who's going to replace that? Here's a crazy thing. If it weren't for Tether and Circle that own $90 billion of treasuries, rates would be in really significant pain right now. And so, and I think the point you said that Andy and the guys were making was that the mix of short duration to long duration is really important, right? Because if you have too much short duration, you're forced to refinance more often, obviously. And if you have to refinance into rising rates, that causes a death spiral. And, what's really odd is we had 0 interest rates on the short end and kind of 2-3% on the long end for a decade almost. Wouldn't you if you were really prudent, have hit that bid and pushed them all to the long end, like issued all 30, 40, 50, 100-year bonds. Why weren't we issuing 100-year bonds? But no, we kept issuing T-bills. And I think we're at the highest level. Is that right? The highest level of T-bills to T-bonds in history.
Behind the surge in U.S. government bond yields over the last 6 months is a simple fact. China and the Fed, long the two biggest single players in the market, aren't buying. In recent decades, the two acquired trillions of dollars worth of U.S. Treasury bonds, financing the big deficits that emerged after the financial crisis of 2008 and the COVID pandemic. Over the last year, the Federal Reserve has decreased its holdings of U.S. Treasury bonds by $650 billion. Public data on China's official holdings show them down by more than $50 billion over the same period, and they're down nearly $300 billion since early 2021. The Fed isn't selling U.S. Treasuries, it's letting them mature and roll off the balance sheet instead of rolling into new bonds. Also, there are big limitations to the publicly available data on China's holdings. Some experts, like Brad Setzer at the Council on Foreign Relations, think China's holdings are more or less flat, rather than down, but that some of the bonds are stashed in places that don't show up in official data. That said, the fact remains that neither the Fed nor China are the big buyers they once were. China became a major buyer of U.S. government bonds about 20 years ago. As its economy boomed, it used Treasury purchases as a tool to help keep its currency from strengthening, helping to boost its exports. Today, things are different. In the U.S., unemployment is low and inflation has been a problem, so the Fed is siphoning out some fuel it previously pumped into the economic engine by shrinking its holdings of government bonds. In China, the economy and the currency are weakening. It now may even be selling some of its treasuries as it tries to support its slumping currency. Further, the worsening relationship between the U.S. and China, as well as America's sanctions on Russia after its invasion of Ukraine, might be giving Beijing a reason to reduce its exposure to the U.S. financial system. Of course, the disappearance of bids from the Fed and the Chinese buyers isn't the only factor behind the recent rise in bond yields, which also reflects a supply onslaught in market views about economic growth, inflation, and Fed policy. But all of these factors point to a higher-for-longer reality, which will make U.S. debt, now at almost 100% of GDP, tougher to manage. Considering the evolving roles of the U.S. and China in the global bond market and the ripple effects on the world economy, what unforeseen challenges or opportunities do you foresee for international investors and economies in the coming years? Let us know your thoughts in the comment section below. Also, feel free to hit that like button, subscribe, and turn on notifications.